September 2008 would become a date carved into financial history like a scar that never healed. The month when a 158-year-old giant collapsed overnight and dragged the global economy into darkness. But what if I told you the real horror didn't begin with bankers' charts or interest rates, but with a simple lie printed on millions of billboards across America? Why rent when you can own a slogan so harmless? It felt almost wholesome, yet behind it lurked a system engineered to fail. A structure built like a haunted house, with cracked walls hidden behind fresh paint. In this story, we will peel back that paint, expose the rot, and confront the truth that nearly destroyed the world. And if you want more true horror history stories that reveal the monsters hiding inside everyday systems, make sure you subscribe and stay until the very end. Because this tale is not just about what happened, it's about what could happen again. In the early 2000s, America was still limping away from the twin disasters of the dot-com crash and the 9/11 attacks, two blows that shook the nation's confidence and left Wall Street twitchy like a recovering addict searching for its next high. And in that atmosphere of fear and uncertainty, the Federal Reserve made a decision that would set everything in motion / interest rates to nearly zero, flooding the economy with cheap money, making borrowing so effortless that the temptation became irresistible. Houses suddenly transformed from places to live into symbols of redemption, hope, and the illusion that everyone, teachers, waiters, students, part-timers, could rise from the ashes simply by signing a mortgage. Mortgage approval became America's new national sport, a game where the rules didn't matter and the referees didn't care because banks had discovered there was far more profit in saying yes than saying no. So families with modest incomes were offered $500,000 loans with a smile, and when they hesitated, lenders smoothed their fears with exotic terms, adjustable rates, balloon payments, interest, only periods, ninja loans. Suddenly owning a home was not just easy. It was expected, celebrated, demanded, as if the entire country was swept into a fever dream where property was the new currency of personal worth. The ninja loan, no income, no job, no assets, was the crown jewel of the madness. A financial product that sounded like a joke until you saw the real paperwork, a loan approved. Not because borrowers were qualified, but because banks no longer cared whether the money came back, creating a world where even someone living in a van could be congratulated for qualifying for a luxury condo. And this wasn't fiction or satire. This was policy. This was business. This was the American dream, inflated until it barely resembled reality at all. The machine behind this frenzy was powered by a single assumption repeated, like scripture on Wall Street. Housing prices would always go up no matter what, no matter who bought, no matter how absurd the lending standards became. And this belief spread through suburbs, cities, and small towns like a contagious optimism, convincing ordinary people that flipping houses was the fastest path to wealth, turning neighborhoods into speculative arenas where everyone from baristas to high school teachers was juggling multiple properties while barely understanding the loans they had signed. Real estate lost its identity as shelter and became a lottery ticket, a miracle investment that promised ever-rising profits. So people bought second homes, third homes, even fourth homes. They never planned to live in stacking mortgages like collectibles, trading properties like baseball cards. And all the while, mortgage brokers raked in commissions. Lenders printed loans like monopoly money, and advertising campaigns painted homeownership as a patriotic duty rather than a financial decision, setting the stage for a catastrophe nobody wanted to see. But beneath the glossy brochures and golden promises was a dangerous truth. The subprime mortgages fueling the entire boom were fundamentally rotten, filled with shaky documentation, unverifiable incomes, and borrowers who were already drowning. Yet Wall Street had invented a magic trick to disguise the decay, bundling thousands of these toxic loans together into mortgage-backed securities, slapping a shiny label on them, and selling them to investors around the world as if they were solid gold instead of a ticking time bomb. The deception deepened when ratings agencies, the institutions meant to assess risk, allowed themselves to become part of the performance, stamping these Frankenstein bundles of debt with AAA ratings, the highest mark of safety, even when they were filled with bankrupt baristas, unemployed gym bros, and families barely scraping by. And the conflict of interest was staggering. The agencies were being paid by the same banks whose products they were rating, creating a system where honesty was optional but profit was guaranteed. Wall Street's creativity didn't stop with mortgage-backed securities. Once they realized they could bundle junk and sell it as treasure, they took their financial alchemy to even darker places, slicing and remixing those bundles into collateralized debt obligations. CDOs, complex structures designed to look sophisticated, intelligent, and safe. But in truth, they were labyrinths hiding layers of risk so dense that even veteran analysts struggled to understand them, yet investors bought them anyway, trusting the chip-away label like a talisman against disaster. Amid the euphoria and delusion, only a small handful of investors saw the cracks forming beneath the glittering surface oddballs and skeptics who actually read the fine print, examine the loan data, and realize that the entire system was resting on quicksand, prompting them to ask a question so outrageous that Wall Street laughed in their faces. What if we bet against the housing market yet? Instead of rejecting the idea, the banks, hungry for fees and blind to risk, agreed to create a new product that would one day help destroy everything. The credit default swap insurance you could buy on an asset you didn't even own, an invention that turned the financial market into a casino where people could profit from collapse. With credit default swaps unleashed into the world, the financial system transformed from a marketplace into a battlefield where everyone quietly rooted for someone else's house to burn, because now you could profit from failure, you could make money from collapse. And the banks sold these swaps with unchecked enthusiasm, convinced the housing market would never fall, convinced that the fees they collected were pure profit, with zero danger, unaware or unwilling to accept that they were constructing a weapon pointed directly at their own skulls. Every new layer added to the financial tower made it taller, richer, and more unstable, like stacking Jenga blocks soaked in gasoline, each one representing a subprime loan, a mortgage-backed security, a CDO, or a credit default swap. And despite the visible wobbling, despite whispers from analysts who sensed something unnatural beneath the surface, Wall Street continued popping champagne, handing out record bonuses, and celebrating the endless upward climb, blind to the fact that the tower had already begun to crack from within. Meanwhile, on Main Street, the early signs of disaster appeared quietly, almost politely. A missed payment here, a default there, a foreclosure sign planted in front of a house that had once hosted backyard barbecues. And at first, these incidents were dismissed as statistical noise, tiny dents in an otherwise booming economy. But like the first tremors before an earthquake, they signaled something far larger and far more terrifying, brewing under the surface. By 2007, the whispers had become sirens as subprime loans began collapsing en masse, revealing the horrifying truth that the foundation of the housing boom was not rock but dust. And when borrowers stopped paying, the mortgage-backed securities built on those loans started rotting from the inside, losing value so quickly that banks holding billions of dollars worth of these safe assets suddenly found themselves clutching radioactive garbage, unable to sell it, unable to hide it, unable to pretend it wasn't happening. The illusion shattered when major hedge funds reported catastrophic losses, and suddenly the quiet anxiety on Wall Street erupted into full-blown panic as investment banks wrote down billions, credit departments froze in terror. And everyone who had once celebrated the housing frenzy began scrambling to figure out which piece of the tower would fall next. Because now it was clear that this wasn't a minor correction or a market hiccup. It was the opening chapter of a systemic collapse. And then in September 2008, the unthinkable happened. Lehman Brothers, a 158-year-old institution that had survived wars, depressions, and political upheavals, simply ceased to exist, imploding under the weight of toxic assets and leverage so extreme that no bailout, no rescue plan, no last-minute miracle could save it, leaving behind a $600 billion crater that sent shockwaves through the global financial system like the detonation of an economic nuclear bomb. Lehman's collapse was more than a bankruptcy. It was a message written in flames across the world's markets, a warning that if a titan like that could fall, then no bank, no fund, no government-backed institution was truly safe, and the reaction was immediate and brutal. Credit markets froze, solid banks refused to lend even to each other, businesses were denied basic financing, and the entire global economy felt as though someone had pulled the power cord from the wall. The freeze spread like frostbite, creeping into every corner of society. As families discovered they could no longer get mortgages, small businesses couldn't secure loans to make payroll, and investors found their accounts locked, frozen, or drained, while retirees watched decades of savings evaporate in real time, their 401ks shrinking like dying stars, and the job market collapsed so fast that unemployment lines resembled disaster relief camps more than normal bureaucratic offices. It was not just Wall Street burning, but Main Street drowning as foreclosures soared to historic levels. Eviction notices piled at the doors of once stable families and soup kitchens, symbols of a bygone era of hardship, became overwhelmed by crowds of newly desperate people who had once believed themselves safe, protected, immune to the chaos that now consumed their lives with merciless indifference. What began as an American crisis mutated into a global contagion, spreading across borders with terrifying speed. Iceland's major banks collapsed. Tokyo's stock market plunged. European leaders scrambled like firefighters trying to contain an inferno that leapt oceans effortlessly. And from London to Sao Paulo, from Hong Kong to Reykjavik, financial systems buckled under the pressure, leaving the world to wonder not which country would fall next, but whether the entire global system was fundamentally broken beyond repair. As governments watched their economies buckle under the weight of collapsing credit markets, panic spread through political halls as quickly as it had across trading floors, because the realization hit like a punch to the throat. This was no longer a financial correction or a cyclical downturn, but a full-blown systemic failure. And without intervention, banks would fall like dominoes, businesses would go dark, and millions more would be thrown into economic freefall, creating a disaster with social consequences too terrifying to imagine. Faced with a choice between letting the system burn or stepping in to perform financial triage, the U.S. government chose the option most hated by the public, yet deemed necessary by economists, a bailout monumental in scale, unprecedented in scope, and deeply controversial, a lifeboat thrown not to the ordinary families drowning in debt, but to the very institutions whose reckless behavior had helped ignite the crisis in the first place, a decision that would haunt political discourse for years. In October 2008, the Treasury unveiled the Troubled Asset Relief Program, TARP, a $700 billion emergency fund designed to inject capital into failing banks, buy toxic assets, and stabilize the crumbling system. And though it was described as a rescue plan, many Americans saw it as a betrayal, a moment when the government chose to protect the powerful instead of the vulnerable, reinforcing a belief that the financial world operated under two sets of rules, one for Wall Street and one for everyone else. But the bailout didn't stop with banks. The crisis had seeped into every corner of the corporate world, taking down industries once considered untouchable. So when AIG, the global insurance giant, revealed it had bet trillions on risky credit default swaps and now faced imminent collapse, the government poured more than $180 billion into saving it, calling the firm too interconnected to fail, a phrase that would become synonymous with moral outrage and systemic inequality. The carnage extended even further as iconic American car manufacturers like General Motors and Chrysler teetered on the edge of bankruptcy, their supply chains disrupted, their financing frozen, their customer base evaporating. And without government intervention, millions of jobs could disappear overnight. So the administration unleashed an additional $80 billion in support, transforming the crisis into a moment where capitalism and government blurred into something desperate and messy, a partnership forged in fear rather than ideology. Meanwhile, the Federal Reserve embarked on its own crusade to prevent total economic collapse, slashing interest rates to near zero to make borrowing almost free and deploying a radical, unprecedented strategy known as quantitative easing, printing money digitally and using it to purchase bonds and mortgage-backed securities in a massive attempt to flood the system with liquidity, a move critics compared to patching the hull of a sinking ship with stacks of freshly printed cash. For Wall Street, the interventions were a lifeline, a reassurance that the financial system would not be allowed to die, and gradually, slowly, painfully, markets began to stabilize. Banks unclenched their frozen credit lines, and investors dipped their toes cautiously back into the market, culminating in a stock market bottom in March 2009 that marked the beginning of a long, resilient rebound, but the recovery was uneven, unequal, and deeply unfair in the eyes of millions. Because while Wall Street breathed sighs of relief and executives returned to offices with their bonuses restored, Main Street remained suffocated under the debris of the collapse as unemployment soared to 10%, 8 million jobs vanished, seemingly overnight, and 4 million homes were foreclosed, leaving entire neighborhoods littered with abandoned houses whose shattered windows reflected the despair of families who had lost everything through no fault of their own. Household wealth evaporated on a scale so dramatic it resembled wartime devastation, with $19 trillion wiped from American families' financial foundations. And as people struggled to rebuild, many found themselves owing more on their mortgages than their homes were worth, trapped in a form of economic quicksand where every payment felt like sinking deeper into a debt they could no longer outrun, a psychological burden that left lasting scars long after the stock charts turned green again. The contrast became impossible to ignore. Bankers toasted with champagne as ordinary people stood in line for unemployment benefits and food stamps, a stark, almost grotesque visualization of systemic imbalance that ignited national rage. And by 2011, that anger erupted into the streets as thousands gathered in Zuccotti Park in New York City, launching the Occupy Wall Street movement, waving cardboard signs that declared, "We are the 99%," a slogan that captured a collective feeling that the system was rigged to protect the wealthy while sacrificing everyone else. Occupy Wall Street was more than a protest. It was the collective scream of a generation that realized the crisis wasn't just an economic failure, but a moral one, a revelation that when the financial system gambled and lost, the public paid the price. Yet when ordinary people stumbled, there was no lifeline, no bailout, no sympathetic politician rushing to their aid, only eviction notices, overdraft fees, and the cold indifference of institutions that claimed the collapse was unpredictable, even as internal emails later revealed they had seen the warning signs and ignored them. As tents filled the park and crowds grew day after day, the movement became a mirror held up to America, reflecting uncomfortable truths about inequality, power, and privilege. And although authorities eventually dismantled the encampments, they could not dismantle the anger, the disillusionment, or the new vocabulary that entered public consciousness. Phrases like too big to fail, too big to jail, and systemic corruption ideas that would shape political debates for years to come and redefine how people viewed the financial world. While most Americans struggled through layoffs, wage cuts, and shrinking retirement accounts, Wall Street experienced a faster resurrection than anyone expected, fueled by bailouts, cheap money, and a stock market that recovered far more quickly than the job market. and the return of multi-million-dollar bonuses for executives whose decisions had helped trigger the crisis created a sense of bitter irony, as if the arsonists had been rewarded while the victims sifted through ashes looking for pieces of their former lives. Investigations into the collapse revealed a labyrinth of negligence, deception, and insatiable greed. Mortgage brokers who falsified income statements to close deals, banks that knowingly packaged toxic loans into safe investment products, rating agencies that rubber-stamped junk as a way for profit, and executives who ignored internal warnings because acknowledging the danger would have meant sacrificing short-term gains, creating a culture where profit eclipsed ethics, risk eclipsed responsibility, and humanity was lost beneath spreadsheets. Yet despite the mountain of evidence, the parade of whistleblowers, and the public rage that demanded accountability, not a single major Wall Street CEO went to prison, a reality so surreal it bordered on dystopian, reinforcing a belief that the financial elite existed above the law, protected by a system too intertwined with political power to punish those responsible, and that failure on a grand scale could still be cushioned by golden parachutes instead of consequences. In the aftermath, governments around the world debated reforms, passing regulations designed to increase transparency, reduce leverage, and prevent another meltdown. But the complexity of the financial system, combined with lobbying from powerful institutions, ensured that many of the most meaningful reforms were watered down, delayed, or quietly abandoned, leaving behind a lingering fear that the crisis had been a warning the world failed to fully heed, like a near-death experience, quickly forgotten once the heartbeat steadied. Meanwhile, millions of ordinary families faced consequences that did not fade, with the stock market's recovery, long-term unemployment destroyed, credit scores, uprooted childhoods, broken marriages, and emotional trauma that economists rarely calculate, but that shaped a decade of lost opportunity. As children who watched their parents lose homes, grew up to distrust banks, and workers who survived layoffs carried silent anxieties about job security that haunted them long after the headlines moved on. Beyond the numbers and charts, the crisis reshaped psychology itself, eroding the belief that steady work guaranteed stability, that the middle class was safe, or that the system rewarded responsibility. And for many, it replaced those old assumptions with a darker understanding of how fragile financial life truly was, how quickly savings could evaporate, how easily institutions could betray the people who trusted them, and how little control individuals had over forces far larger than themselves. As the world slowly rebuilt, experts warned that the next crisis might not resemble the last one at all, because financial systems evolve, new products emerge, and risk often hides in unexpected places. And while safeguards were implemented to prevent another subprime meltdown, new vulnerabilities appeared: rising corporate debt, automated trading systems, shadow banking networks, each carrying its own potential to ignite disaster, waiting silently for the right spark. The great irony of 2008 is that its most enduring legacy was not the reforms, not the protests, not the bailouts, but the lesson that crises often look harmless until the moment they explode, that booms often hide bubbles, that confidence often mutates into delusion, and that the world can stand on the brink of catastrophe without realizing it. Because the true horror of the financial system is not just how it collapses, but how easily we convince ourselves it never will. In classrooms across the country, teachers struggled to explain to confused teenagers why their parents had lost homes, why their savings had vanished, why college funds had evaporated. And the hardest part wasn't the complexity of mortgage-backed securities or credit default swaps, but the painful truth beneath it all, that adults in powerful rooms had gambled with ordinary people's lives and lost, leaving the next generation to grow up with an inherited distrust of the financial world and a fear that stability could vanish without warning. Inside living rooms, families whispered about bankruptcy the way earlier generations whispered about illness, ashamed to speak too loudly of the foreclosure notices tucked into drawers or the unopened bills stacking on kitchen counters, and many who had once felt secure found themselves navigating charity lines for the first time, discovering that poverty could descend with shocking speed even on those who had worked hard, saved diligently, and done everything right, a reminder that the system they trusted had been far more fragile than they ever realized. In cities, entire neighborhoods transformed almost overnight as rows of foreclosed houses sat empty, their lawns overgrown, their windows shattered by vandals, their hallways echoing with the absence of families who had once filled them with laughter. And these ghost streets became haunting symbols of the crisis, physical monuments to the cost of unchecked greed, where the American dream had decayed into silence and dust. For immigrants who had come to the United States chasing stability and prosperity, the crisis carried a unique cruelty as many discovered that their limited English, lack of legal knowledge, or unfamiliarity with the banking system made them prime targets for predatory lenders who promised opportunity but delivered ruin. And when the crash came, these families fell hardest, quietly losing homes and savings with no headlines to mark their suffering, only the quiet grief of dreams dissolving. Communities of color already facing decades of economic barriers were devastated on a scale larger than most Americans realized as banks disproportionately steered Black and Latino families into subprime loans, even when they qualified for safer ones, turning their neighborhoods into epicenters of collapse. And when the dust settled, millions of dollars of generational wealth had been wiped out, deepening inequalities that would linger for decades and revealing that the crisis had not struck all Americans equally. Even decades later, economists would debate whether the bailouts widely hated but arguably necessary had saved the world from something far worse, because some experts believe that without government intervention, the collapse could have spiraled into a second Great Depression, complete with mass bank failures, frozen, global trade, and unemployment levels unseen in modern history. An economic apocalypse narrowly avoided only through decisions that felt morally repugnant yet strategically unavoidable. But for the average family, those abstract discussions meant little because no academic model could quantify the humiliation of losing a home, the fear of telling children they had to move, or the psychological toll of watching a lifetime of savings evaporate. And while policymakers debated charts and projections, millions of individuals silently endured the emotional aftershocks of a crisis that had fractured their sense of security permanently. Among survivors of the crash, a subtle but profound shift occurred. Savings replaced spending caution, replaced confidence, and people became less willing to trust banks, corporations, or even the economy itself, reshaping national behavior in ways that economists struggled to model. Because trauma, especially financial trauma, does not fade when markets recover. It lingers, reshaping the way people think, spend, save, and hope for the rest of their lives. On Wall Street, however, the lessons learned were different and far more concerning. Financial institutions emerged from the crisis knowing that if their bets were large enough and their risks widespread enough, the government would be forced to rescue them to prevent systemic collapse, creating a dangerous moral hazard that whispered a seductive promise to bankers: take risks boldly because failure might hurt the world, but not necessarily you. And so the world found itself living with a chilling paradox. The crisis had exposed the fragility of the financial system, yet it had also solidified the power of the very institutions that caused the turmoil, leaving society more aware but no safer, more educated but no more protected. And while the rubble of 2008 was eventually cleared away, the shadow it cast remained long and dark, a reminder that the next catastrophe might already be building quietly and visibly behind assumptions that feel as unbreakable as housing prices will always go up. As policymakers attempted to reassure the public that reforms would prevent a repeat of 2008, a quieter truth settled beneath the surface. Financial crises rarely repeat in the same form, and while the world focused on subprime loans and Wall Street traders, entirely new risks were already germinating in the shadows hidden inside complex algorithms, unregulated shadow banks, and technological systems so intricate that even their creators struggled to fully understand the consequences of their failure. In the years that followed, global markets became increasingly automated, with high-frequency trading algorithms executing millions of trades in milliseconds, creating a financial environment where a single glitch coding error or cascading feedback loop could trigger chaos faster than any human could respond, a terrifying vulnerability that experts warned could lead to flash crashes or systemic disruptions with almost no warning. Meanwhile, corporations across the world began accumulating unprecedented levels of debt, taking advantage of low interest rates to borrow, cheaply, expand aggressively, and inflate their balance sheets. A trend that quietly mirrored the same overconfidence that fueled the housing bubble as businesses assumed that economic stability would continue, indefinitely ignoring that history had already proved how dangerous such assumptions could be. Shadow banking financial activity occurring outside traditional regulated institutions grew into a vast and opaque ecosystem filled with hedge funds, offshore entities, and complex lending networks that operated beyond public scrutiny. And although these institutions lacked the safety nets of conventional banks, they still held trillions in assets, creating the possibility that a failure in one hidden corner could set off a chain reaction through the global system. Even ordinary consumers, though more cautious than before, found themselves pulled back into familiar patterns encouraged by new forms of digital credit, buy now, pay later schemes, and financial apps that allowed borrowing with a single swipe, making debt feel frictionless and harmless. Even though the risks remained as real as ever, buried beneath user-friendly interfaces that masked the same psychological traps that had once fueled the housing boom. International leaders attempted to revive trust by implementing new regulations such as the Dodd-Frank Act, which imposed stricter oversight on banks, strengthened consumer protections, and required institutions to hold more capital as a buffer against future shocks. But as the years passed, many of these measures were weakened, challenged, or rolled back, entirely eroding the safeguards meant to prevent another catastrophe, and raising the question of whether the world had truly learned anything lasting from the crisis. For many economists, the most haunting part of 2008 was not the collapse itself, but how easily it could happen again under different circumstances, because the core ingredients of disaster greed, complacency, blind optimism, and a belief that markets self-correct remained deeply embedded in the global financial culture, a set of human flaws immune to legislation destined to reappear in new guises as long as profit existed. Survivors of the crisis carried the memory like a phantom limb, an invisible pain that resurfaced whenever headlines warned of market volatility, whenever layoffs were announced, whenever interest rates moved sharply. And this collective anxiety became part of the social fabric, shaping conversations about money, work, and risk, a living reminder that stability is never guaranteed no matter how confident the world appears on the surface. In many ways, the true legacy of the crisis lies not in the billions lost or the institutions saved, but in the distrust it left behind, a fracture in society's belief that the financial system operates fairly, that hard work leads to security, or that governments protect the vulnerable. Instead, millions learned firsthand that the system prioritizes itself, that justice is uneven, and that survival often depends less on responsibility and more on luck. And as the world marched further from 2008, The eerie silence that followed the recovery concealed a deeper, more unsettling truth. Crises are rarely born from loud, obvious danger, but from quiet assumptions, invisible pressures, and comforting beliefs that go unchallenged for too long. And while the global economy celebrated its rebound, the same dangerous myth that once fueled the housing bubble began to whisper again in boardrooms, trading floors, and ordinary households. The myth that nothing this strong, this big, this interconnected could ever fall. Yet anyone who lived through 2008 knew the danger of believing in permanence, because the crisis had revealed how the world's most trusted institutions could crumble overnight, how fortunes could evaporate in a week, and how millions of lives could be rerouted by decisions made in boardrooms far from their homes. And this memory persisted like a warning etched into the collective conscience, whispering that confidence often precedes collapse, and that every boom carries within it the seed of its own destruction. For families who lost everything, the passage of time did not erase what happened. It merely layered new experiences over old wounds, and long after markets recovered, children still remembered the night their parents sat silently at the kitchen table staring at foreclosure papers. Couples still remembered the humiliation of packing their belongings onto front lawns, and workers still remembered the moment they realized the job they had relied on was gone, not because of their performance, but because the system had failed them. In conversations years later, many survivors describe the crisis not as a single moment, but as a slow motion unraveling, a period when each day brought a new piece of bad news, a new fear, a new understanding that the stable world they had believed in was an illusion. And this realization changed them, making them more cautious, more skeptical, more aware of how fragile prosperity could be and how quickly hope could turn into uncertainty. Even those who appeared to recover financially often carried invisible scars, a hesitation to invest, a reluctance to take risks, a lingering distrust of institutions that promised security but delivered chaos. And this psychological shift, subtle yet profound, would shape the behavior of an entire generation, influencing their spending, saving, career choices, and even their willingness to start families, because trauma, especially economic trauma, does not simply vanish, it evolves. And somewhere inside this collective memory lay an uncomfortable truth. The financial system that billions depended on was not a fortress, but a web interconnected complex and vulnerable to the slightest tear. And though reforms attempted to reinforce it, the same human impulses that once inflated the housing bubble, greed, ambition, overconfidence, continued to pulse beneath the surface, waiting for the right conditions to ignite once more. Looking back, analysts often debated which mistake mattered most: the reckless lending, the negligent oversight, the corrupted ratings, the blind faith in rising home prices, or the belief that markets could police themselves. But in the end, the crisis was not caused by a single error, but by a culture that rewarded risk, ignored warnings, and prized short-term profit over long-term stability. A culture that allowed a lie. Why rent when you can own to grow into a global catastrophe? The haunting part is that crises, like nightmares, do not need to repeat themselves exactly to return. They only need familiar conditions, complacency, optimism, leverage to slip back into place. And as long as humanity continues to chase profit faster than wisdom, there will always be another bubble, another collapse, another moment when the world looks back and wonders how it missed the signs that were there all along. For those who study the crisis, the greatest lesson is not about housing or banking or monetary policy, but about human nature itself, about our ability to cling to comforting illusions even as cracks appear beneath our feet, about our tendency to trust systems that seem too big to fail, and about our collective blindness to the truth that stability is not a guarantee, but a temporary balance that requires vigilance, humility, and accountability to maintain. And so the story of 2008 stands as a modern parable, a reminder that the monsters that haunt our world are not supernatural beings lurking in shadows, but flawed decisions, unchecked greed, and the willingness of people in power to ignore danger when the profits are too tempting. A story that will continue to echo through history. Every time a market surges too quickly, every time borrowing becomes too easy, and every time society convinces itself that this time is different. In the end, the true horror of the 2008 financial crisis is not the trillions lost, the homes foreclosed, or the jobs destroyed. It is the realization that the world remains vulnerable to the same forces today, and that the next crisis, whatever form it takes, will arrive quietly disguised as opportunity, growing in the shadows until the moment it erupts, reminding humanity once again that the line between prosperity and disaster is far thinner, far more fragile, and far easier to cross than anyone ever wants to believe.